Hey guys, Christian Tuition here, and this is video number 11 of my PoA MCQ prep, the July 2020 CSEC exams. If you want to see all of the other videos, I'm going to put a card up there with a link to the playlist, and I'm also going to link that playlist in the description below. Also, I'm going to put a link in the description to my website where you can get a free handout with the formulas for the ratios and some brief explanations. So if you haven't yet done so, pause the video, go down to the description, find the link where it says handout, ratios handout, click on it, download it, and use that to follow along here. If you have all those things already, let's get started because I have 48 questions to do with you guys right now. So let's get started. Okay, so question number 1. Where's my cursor? Oh, there it is. All right, cool. So the formula for gross margin is given by which of the following? So if you have downloaded that PDF and hopefully you have it in front of you somewhere on a side, you will know the formula for gross margin. It is simply gross profit divided by net sales. Now, you're going to see gross profit divided by sales. In some cases, if you don't have net sales, it is fine to use just the sales figure. As a matter of fact, there is a question that repeats almost every year in the CSEC May exam. I've seen it sometimes in January, where they give you, it says gross margin, and they give you one figure over another, and they ask you, what is the denominator? And they don't have net sales, but they do have total sales as an option. None of the others are correct, but that one is total sales. But the correct formula for gross margin is gross profit divided by net sales. And it's expressed as a percentage, so you'll see multiplied by 100. Let's check out question 2, shall we? So, hold on, bring back down a little bit. Come back down. Right, okay. So, which of the following best describes what the gross margin or gross profit margin measures? So, if you have downloaded that handout, you're going to see some notes accompanying it. So, if you put gross profit over net sales and find a percentage, you are asking yourself, what percentage of net sales is gross profit? For example, if your gross profit was, let's say, $20 and your net sales was, let's say, 100, 20 over 100 is 20%. And on top of that, what does it really mean? Well, it means that 20% is the proportion of every sales dollar that remains after subtracting your cost of goods sold. Let's think about that. How do we find gross profit? Net sales minus cost of goods sold. So we're taking away cost of goods sold from net sales, and what remains is gross profit. So gross profit is the dollar amount that remains from your revenue, your net sales, after taking out your cost of goods sold. So from the percentage perspective, it is simply that same concept in a percentage format. It is the percentage of total of net sales that remains after paying for your cost of goods sold or paying for your goods that you have sold. So let's see. How much revenue is left out? How much money is left out of revenue after covering cost of goods sold? Oops, press the wrong button. So A is the correct answer. How much money? Now it says the cost of goods sold as a percentage of sales? No. Percentage of each sales dollar that goes towards covering cost of sales? No. The percentage of each sales dollar that remains after covering cost of goods sold? Well, actually, that is the correct answer. Yeah, because it says percentage. This one up here, why is this one wrong? Can anybody tell me? I'm watching any comments. Which side are we on? Yeah, you're on that side, right? Cool. So this is actually just gross profit. That's how much money, the dollar figure, right? So just a point to note here. This is why it is very important to read all of your options, because you may pick one at first that you may figure, well, that's the correct one. And then you go down a couple and you're like, wait, no, but this one is actually better. So I meant to do that. Yeah. All right. So the gross profit margin is the percentage of each sales dollar that remains after covering cost of goods sold. Okay, let's go down to number 3. So it says, using the information in the table below, answer the following questions. So we have sales, opening stock, purchases, closing. So what is a gross profit margin? So to find gross profit margin, we need gross profit and to divide by net sales. Now, we know net sales is sales minus returns inwards, but however, we don't have a returns inwards figure in this question. So we're going to just have to use the sales figure. So how do we find gross profit? That's sales minus cost of goods sold. Now, just by the way, I'm going to link in the description below to my video where I teach how to do the trading account from scratch, from the ground up. And I'm not just giving you a format, I'm explaining all of the logic behind it. Now, it's one of my earlier videos, so it's not as well made as these ones are. Not that these are overly fancy, I have a lot to learn still, but those slightly cringy. And my hair was doing all kind of weird madness. So anyhow, so we have, so it's opening stock plus purchases. 30 and 80 is 110. And we have to minus from that the closing stock. 110 minus 20 is 90. Now that's cost of goods sold, and we're going to take cost of goods sold and subtract it from sales to find gross profit. 120 minus 90 is 30. So your gross profit is 30,000. We're going to take 30,000 and put that over 120. 30 over 120 is a quarter, and a quarter is 25%. I thought I highlighted it. Okay, so I just have to click on that. Cool. All right, let's go back up and scroll across to number 4 now. So we have answered the question based on the table below. So we have sales, sales returns, gross profit margin. What is the gross profit? Oh, okay. So gross profit. So if you have your gross profit margin, all you have to do, think about it from this perspective. If your gross profit over net sales by 100, if that is equal to gross profit margin, if you wanted to find gross profit, you just multiply net sales by a margin, by a gross profit margin. So net sales is 280, sales minus sales return. So 280 minus 40, which is 240. 25% is a quarter. A quarter of 240 is 60. Okay, scrolling down to number 5. So answer the question based until below. Okay, so company A, company B. So we have two companies and we have their gross margin. So we have 33% for A, 25% for B. So basic observation, company A is making a higher gross margin. Let's see what the question is asking us. So which of the following statements could most likely be true based on the above information? Ooh, some analysis. So it's not just calculations, it's analysis now. We have to think. So let's take a read. Company A had a proportionally lower gross profit than did company B. So proportionally, that deals with the percentage. Now, it's quite easy to think company A, because it had a 33% gross margin, had a bigger gross profit. That's not necessarily true. Because let's imagine for a second, let's say company A had 3,000 in terms of net sales. 33% is about a third. So a third of 3,000 is 1,000. So that's its gross profit. But what about if company B had net sales of, let's say, 100,000? 25% of 100,000 is 25,000. So just because it's a lower percentage doesn't mean it's a lower dollar figure. It means the proportion, the percentage of net sales that remains after subtracting cost of goods sold, the percentage of net sales left as gross profit is lower than in company B than for company A. That is true, the proportion, the percentage, not necessarily the dollar amount. So please be careful with that. So company A, oops, I don't know why I keep doing that. Right, so company A had a proportionally lower gross profit. No, it had a proportionally larger. Company A's dollar amount for gross profit was greater than that of company B. Well, I just explained why that is not true. Company B had a proportionally higher cost of goods sold than did company A. Right, so that is true because think about it. If your gross margin is 25%, sorry, right? Not 25%, sorry, but 25%, comma, sorry. Your gross margin is 25% of your net sales. And think about it. It's 25% of net sales. So how do we get from net sales, we minus in something and left with 25%? What would we have had to subtract from net sales to get back 25%? 75%. Net sales is what we call the base figure. We're basing our calculations on that figure. 25% of the net sales, if net sales is 100%, it's going to be 25%. But to get to 25%, having subtracted something from the 100, it means that you're subtracting 75%. Now that makes sense in that this option makes sense, sir. This option says company B had a proportionally higher cost of goods sold than did company A. So this had a 75% cost of goods sold, this had a 67%. So that is correct. Right. So like I said, I was trying not to just put straightforward calculation questions, straightforward definition questions. It's quite possible they can ask you these things. Now, to be honest, I have scoured, like I said, about 12 years with the past papers. They've never asked something like this. But even though it is rumored that they have said that the papers were printed since before the whole COVID-19 lockdown, and we don't know exactly what they printed, 20% of the questions are always unseen. they're always new. So let's just give it a good shot. All right, scrolling down to number 6 now. So answer the question based on it here. So Bing Zorpius, this is the name I have for my fiance's son. I was calling him all kind of things. His name is Sage. All right, so 2019, 2018. So gross margin. So it looks like 2018's gross margin was 20%. 2019 was 17.8. So the gross margin went down. Okay, so which of the following statements could most likely be true based on the above information? So it says gross profit margin fell between 2018 and 2019. Yeah, well, that was easy. Let's just take a look at the others, right? It says here, cost of goods sold as a proportion of net sales rose between 2018 and 2019. That is true because for the gross profit margin, remember, like I said, the net sales is the 100% figure, and you're minusing cost of goods sold, whatever the percentage it is, and you're going to be left with gross margin, sorry. So if in 2018 we were left with 20%, it means we subtracted 80. But if here we're left with 17.8, it means we subtracted 82.2. So yeah, B is also correct. All right, what about C? The proportion of net sales remaining as gross profit fell from 2018 to 2019. That is true as well. This movement, this fall in gross margin means all of those things, right? The gross profit margin fell. That is correct. And that also means cost of goods sold as a proportion of net sales rose. We had a higher cost of goods sold, which means a lower gross profit, percentage-wise. And the proportion of, well, this is exactly the same as this, right? So it means here, all of the above. Okay, I thought the yellow came on. Oh no, I undid the highlight, right, there you go. Okay, let's scroll down and go back across to number 7. So the formula for net margin is given by which of the following? So net margin is the net profit version to gross profit. So we're going to take net profit and divide by net sales. So as you can see, in some cases, you might only have sales, but the actual formula is net profit divided by net sales. That is the more accurate of the two formulae. Right, and that of course is going to be equal to net, hold on. Right, equals net profit margin, right? I'm going to use that a bit later. Right. So let's go down to number 8. So which of the following best describes what the net margin or net profit margin measures? So the net profit margin is net profit over net sales by 100, which is expressing net profit as a percentage of sales. So just like with the gross profit margin, net profit margin is the proportion of net sales that remains after covering all of your expenses, both the cost of goods sold and all other non-trading expenses, all of your operating expenses. So let's go to C. Let's see, what does C say? The proportion of each sales dollar that remains after covering both cost of goods sold and OPEX. There you go. Yeah, well, you can call operating expenses OPEX for short. So the percentage of net sales that remains after covering only operating. No, okay, so I was just double checking. Let's go down to number 9, shall we? So answer the question based on the table below. So we have sales, cost of goods sold, operating. What is the net profit margin? So net profit margin is net profit divided by net sales. Now we don't have returns inwards and we don't have net sales, we just have sales. So we're going to have to make do with that for the calculation. To find net profit margin is, net profit is gross profit minus operating expenses. And to find gross profit, we need sales minus cost of goods sold. So 250 minus 120 is 130. 130 minus 80 is 50. That's net profit. And if you put 50 over 250, that gives us a fifth. And 1/5 is 20%. All right, let's go back up and go across to number 10. So answer the question based on, okay, so sales, sales returns, net profit margin. What is the net profit? Right, so just like any previous question, if we have the profit margin and we have net sales, we can simply multiply the margin by the sales, net sales. And we can find net sales because we have sales and sales returns. So 380 minus 30 is 350. 20% of 350, that's a fifth of 350 is 70,000. Nice. Let's take a scroll down and check out number 11. So you'll notice that these are a little similar to the questions for gross profit margin. I just kind of kept the format the same, but it still has different interpretations. So it's not like it's overly repetitive. So we have two companies, C and D, and we have their net margins. So we can see that company C had a lower net margin than company D. Which of the following statements could most likely be true based on the above information? Company C had proportionally lower operating expenses than the company D. So if they had lower operating expenses proportionally, well, let's see, what is the proportion? If your net margin is 20%, now you might say, well, it's 80%, but remember, that's a combination of cost of goods sold and operating expenses. So we don't know, we're not sure. We can't speak specifically to operating expenses. So maybe we could bypass everything with OPEX for now. So company C had a proportionally lower net profit than the company D. Well, that actually is the answer there. Nice simple answer. Let's see. Company C's dollar amount of net profit was greater. No, we don't know that. Because remember, it's 20% of an unknown figure for us right now. It could be 20% of $1 million for company C and 30% of $500 for company D. In which case, the dollar figure for company C would be bigger than the dollar figure for company D. So dollar amounts, unless we have the net sales in order to facilitate the calculation, we can't tell. Let's scroll down to number 12. So Spligoogs Limited, 2018, there's a net margin, 3% and minus 1%. What is minus 1%? How can we have a minus 1%? Well, that would require a negative figure being divided by net sales. Of course, net sales will have to be positive. And what do we divide by net sales to get net margin? Net profit margin. Net profit. Can net profit be negative? Well, if it's a loss. Ooh, okay, interesting. So which of the following statements can most likely be true? So net profit margin improved. Yes, I could agree with that. From -1 to +3, yes. OPEX expenses as a proportion of net sales fell between 2017 and 2018. It could have, but we don't know for sure. And Spligoogs been a net loss in 2017, yeah, we know that for sure. And then all of the above. Okay, so this is probably an issue with my construction of the question. Yeah, we can't say this for sure. It seems like it's a good assumption, but we don't know. Suppose the gross profit was where we had most of the increase because we had better sales revenue and a lower cost of goods sold. And maybe expenses either stayed the same or went up. We don't know. We can't say B for sure. So this is an error on my part. The answer was intended to be all of the above, so I'll have to go back and fix that. So let me just put a little note here for myself. Let's put it in a green. All right. Okay, let's go down to number 13. How are we doing for time there, guys? Well, about 19 minutes. Wow. All right. So the formula for the return on capital employed is given by which of the following? So once again, hopefully you went to my website and you downloaded the free PDF with all these formulas and their meanings. So it is this one, net profit over capital employed. Now, it is true, sorry, I forgot to go back to the other. It is true that some people use net income, but net income is the same as net profit. But some people use net profit after tax and all sorts of complicated things. And some people use average capital, which is permissible, but it depends on the information given to you in the question. If you're in doubt, always state what formula you use. If you choose to use just capital employed as opposed to average capital, that's fine. Okay, let's go down. So now we're asking, well, what is the return on capital employed? What does it measure? Okay, when people start a business for what reason? To make a profit. And when the profit is made, to whom does it go? Well, the owners, the people who invested in the business. And what goes to them? The profit. And the profit after all expenses have been covered. So that profit is almost like if you make an investment and you get interest on the investment, that net profit is like interest to them. It's a reward on their investment. And that is also called a return, what they get back. So the return on capital employed, if you think about it, it puts net profit over capital employed. What is capital employed? This used to confuse me and many of my friends and students over the years. Capital employed is just capital. Don't let the word employed fool you or confuse you, please. All right, it did that to me. Maybe I was just idiotic. I don't know. I just used to spaz out. Was employed. I don't know. The capital working, but that's working capital. But then working capital is current assets, current liabilities. And I used to spiral like a maniac. Coming back on point. So you're basically putting your reward over your investment. Your reward as the owner is net profit, and your investment is your capital invested or capital employed. So that's C. The percentage return or profit on that the owners receive on their capital investment. This is an arbitrary measure, it means nothing. Nope. This is net profit as a percentage of the total asset value. That was a tempting one for some people, but it's not that. And earnings received by shareholders. Technically, that is a return on the capital, but that's called dividends. And there's actually a similar calculation for them, I think, called dividend yield. But that if you go to Form 6 and do CAPE accounting, you'll learn all that there. Oh, wait, I was supposed to highlight that. Let's get that done, and let's move on to number 15. So, answer the question based on the table below. So, net profit, capital at start, capital. Okay, so this is where the formula using average capital comes in. What is an average? Well, if you want to find an average of two numbers, you add those two numbers together and divide by 2. So 300 and 420 is 720. 720 divided by 2 is 360. So if you take 60 and divide by 360, we're going to get 16.66. Now, if you took net profit and divided by capital at start, you will get 20%. Now, 20% could also be a valid answer, especially if you used capital at start instead of average capital. So C here is the answer. Or that's the answer I intended. Let's go back up now to number 16. Answer the question based on the table below. So we have capital at start, capital at end, return on capital employed. So what is the net profit? So this is a reversal. So to find net profit, you multiply the percentage by the average capital. Or if you're not using average capital and you only use capital at start, 20% of 550 is 110. If we found average capital, well, that's going to give us 1 million. 1 million divided by 2 is half a million. 20% of 500,000 is 100,000. So in this case, C is also correct. Let's go down to number 17. So answer the question. Okay, so we have two companies, E and F. We're comparing the returns on capital. Which of the following statements could most likely be true? Okay, let's take a read. So Company F had a higher net profit than Company E. So once again, we don't know. We just know that the proportion of net profit to capital invested or capital employed is higher for F than for E. Company F had less capital employed. We also don't know that. An investor would earn a better return if he or she invested in Company F. Yeah, that is true. Let's just check D. An investor would earn a better return if he or she invested in, if you invested in E, you'll only earn 25% on your investment as opposed to earning 33% if you invest in F. So D is definitely out. Gespluget, 2018-2019, return on capital employed. So it went up from 32% to 40%. What could be a reason for the movement in the ratio between 2018 and 2019? So for this to increase either, so remember, all of these ratios are all fractions, and fractions increase either by increasing the numerator and holding the denominator the same, or decreasing the denominator, holding the numerator the same, or you increase the numerator and decrease your denominator. So what would that mean for return on capital employed? So either your net profit increased relative to your capital employed decreased relative to your net profit, or both. So capital employed decreased proportionally more than did net profit, yes. Net profit increased proportionally more than did capital, yes. Net profit increased while capital increased. That could have happened too, but we would have to know that net profit increased more. All right, okay, so I think the answer here was intended to be all of the above, but I will have to go and fix this. Oh no, it was supposed to be while capital decreased. Right, now it makes more sense. So yes, all of the above. Right, because remember this one, your numerator would be increasing and your denominator would be decreasing, which will increase a fraction, or in this case, increase the percentage. Okay, let's go down and go across to number 19. So what is the formula for the current ratio? So now we're into the liquidity ratio. So current ratio is current assets divided by current liabilities. So current assets divided by current liabilities. Again, if you have not yet done so, I suggest, or if when the video is done, go to the description, follow the link to my website to download the PDF with the formulas and the explanations. Now, what does the current ratio measure? So it puts current assets over current liabilities, not multiplied by 100. This is simply putting current assets over current liabilities. So you can say it is showing current assets as a proportion of current liabilities. But what it is actually showing is how many times the current asset balance could be used to pay off your current liabilities balance. For example, let's say your current assets was $2,000 and let's say current liabilities was $1,000. 2,000 divided by 1 will give us 2, which means you can use all of your current assets and pay off your current liabilities twice. That's what the current ratio means. It also tells us B, how many dollars of current assets exist to pay off every $1 of current liabilities. So same example, 2,000 of current assets, 1,000 of current liabilities, 2,000 divided by 1 is 2. So $2 of current assets exist to pay off every $1 of current liabilities. So that is also true, which means C is correct because C covers A and B and D can't be correct. Let's go again. Answer the question. Okay, so current assets, current liabilities was the current ratio. So 25,000 divided by 10,000 is 2.5 to 1. So that means there are $2.50 of current assets available to pay off every $1 of current liabilities. Or we could use current assets and pay off current liabilities 2.5 times. Let's go up to number, oops, I scrolled a bit too far there, to 22, right, 22. So if the current ratio of a business is 1.5 to 1 and its current liabilities total 20,000, what is the current asset balance? So imagine that this 20,000 was here in the place of the 1. Current assets is therefore 1.5 times 20,000. And 1.5 times 20,000 is 30,000. If you need to write out these things to make it make sense to you, please go ahead. I am actually not putting many annotations. You're not going to see a lot of the blocks with text appearing because this video is going to be pretty long and it's going to be even longer to edit, and I have a second video to film today as well. I keep saying film like you all might know what I'm talking about, but so record is a better way, right? 23. If the current ratio of a business is 1.25 to 1 and current assets total 25,000, what is current liability? Okay, so this one's a little different. Now we have current assets. We don't have current liabilities, but we know that 25 divided by something is 1.25. So we'll have to take the 25,000 and swap out the current liabilities with the current ratio, the 1.25. And 25,000 divided by 1.25 will give us 20. If you want to double check that, and I always suggest you double check, multiply 1.25, sorry, you can divide 25 by 20. That'll give you 25 over 20 could cancel the 5 over 4, and that's 1 1/4, which is 1.25. Okay, question 24. If the net working capital of a business is 48,000 and its current ratio is 5 to 1, what is the value of its current assets? Ooh, this is an interesting one. So think about it. The working capital is 48. That's current assets minus current liabilities. The current ratio is 5 to 1. This is your current assets figure. This is your current liabilities. Well, the proportions. Current assets is actually 60,000. Let me explain why, right? So if you found 1/5 of this, you get 12, and 60 minus 12 will give us 48, right? So like I said, there's a bit more arithmetic involved. So what you can do, take a pencil and paper and write down A minus L is equal to 48. and A divided by L is equal to 5, and you have a pair of simultaneous equations, you can solve it. All right, but there's always a relationship. Okay, let's scroll on to number 25. So what is the formula for the asset test or quick ratio? So once again, if you've downloaded my handout, it's current assets minus stock divided by current liabilities. Now let's go to number 25 and read. What does the quick ratio measure? So how able the company is to pay off its current liabilities if it is unable to sell stock. That is exactly what it is. Think about the formula. Current assets minus stock. So you are eliminating stock from consideration, divided by current liabilities. So it also means how many dollars of current assets, excluding stock, exist to pay off every $1 of current liabilities. So both A and B are correct. They are just different phrasings that hold the same meaning. Now, why do we exclude stock? Because it is the least liquid current asset. It's never bound to be sold. So let's see, current assets, stock, and current liabilities. So to find the, oh no, this is not supposed to be current. This is supposed to be quick ratio. So 45 minus 5 is 40. 40 divided by 10 is 4. So the asset test or quick ratio in this case is 4 to 1. So $4 of current assets, excluding stock, are available to pay off every $1 of current liability. So you can pay off your current liabilities 4 times. Number 28. Why is stock omitted from the asset test ratio? So I just mentioned this because it is the least liquid current asset. It is never bound to be sold. So if you're in a pinch and you have to sell off everything or you have to pay current liabilities, now your stock might not be able to be used. So because it is never bound to be sold, right? It's the least liquid current asset. 29, sorry. If the asset test ratio of a business is 1.2 to 1, its current assets total 26 and its current liability total 20, what is the value of its stock? Let us think. Current assets is 26, current liability is 20. To get the asset test, it's current assets minus stock divided by current liabilities. Now that's equal to 1.2. So all we have to do is multiply current liabilities by 1.2. That's going to give us 24,000, and that's current assets minus stock. And if current assets is 26 and current assets minus stock is equal to 24, 2,000 is your stock. And if you're not sure, double check. 26,000 minus 2 is 24. 24 divided by 20 will give us 1.2. There you go. All right, number 30. So if the net working capital of a business is 30,000, so net working capital is current assets minus current liabilities, and the asset test ratio is 2 to 1. Oh, and current liabilities is 20. What is stock? Net working capital, that's current assets minus current liabilities. So if we add the current liabilities to net working capital, we're going to get back current assets. So 30 and 20 is 50. So that's current assets. Now, the asset test is 2 to 1. If current liabilities is 20, it means current assets without stock is 2 times 20, which is 40. And from just now, we said current assets in total is 50. So 50 minus 40 would give us 10. All right, so I hope you guys have followed me on those calculations. If not, message me down below. I'll see if I could do a different explanation. Let's go down to number 31. So now we're into the activity or efficiency ratio. So it says, what is the formula? What is the formula for this rate of stock turn or the rate of stock turnover? So once again, if you haven't yet done so, go down in the description, follow the link, download the PDF. Rate of stock turn is cost of goods sold over average stock. Right? Now, what does this measure? What does the rate of stock turn measure? It literally measures the number of times throughout the year that we sold out our average stock. How many times during the year the business sold out its average inventory or average stock. Now, number 33, answer the question based on the table. Okay, so opening stock, closing stock, cost of goods sold. What is the rate of stock turnover? So that's cost of goods sold divided by average stock. How do we find average stock? Opening stock plus closing stock divided by 2. 12 and 8 is 20. 20 divided by 2 is 10. And we're going to take 120 and divide by 10, which will give us 12 times. So we sold out our stock 12 times in 1 year. What else do you think of when you hear 1 year and 12? Is there some link between 12 and 1 year? Keep it in mind. Let's go up to number 34. So if we divide 365 by the rate of stock turnover, what does this give us? So what is 365? That's the number of days in a year. So we're dividing the days per year by the times per year we sell out stock. What's going to happen, and if you've read the handout I've let you download, that is going to give us the number of days it takes to sell our average stock once. So the number of days it takes to sell average stock once. If the rate of stock turnover is 6 times per year, approximately how long does it take to sell average stock? Okay, so remember what I was asking a bit earlier with the question, 12 and a year, is there some connection between 12 and a year? There are 12 months in a year, right? If your rate of stock turn is 6 times, you are selling out your stock 6 times in a year. How long is it going to take to sell your stock? Well, if we take the 365 from above and divide it by the 6, that's going to give us about 60 days. And 60 days is approximately 2 months. And let's scroll down to number 36 now. So that says, if it takes approximately 30 days to sell average inventory, what is the rate of stock turn? So, rate of stock turn is how many times we sell out our average stock in a year. If we take 30 days to sell out stock, how many 30-day periods are in a year? Well, 30 days is about a month, right? In about 4 cases at least. How many months in a year? 12. So we would sell out our stock around 12 times. Another way to do it is to take the 360 or 365 and divide by 30. You'll get about 12. Okay? All right. Let's go down again now. All right, guys. So number 37. What is the formula for the debtors turnover? Time I asked this in class, what's the debtors turnover? And the man says, so coconut? I'm like, no, not that kind of turnover. Anyhow, if you've downloaded the sheet, you know the answer to this. It is net credit sales divided by average receivables. Yes, in some cases, they don't give you credit sales. In some cases, they don't give you net sales or net credit sales. You just have sales. Use what you have. But correct formula is net credit sales over average receivables. So let's put that in yellow. Let's scroll down and ask, what does it measure? The number of times we receive the average value of receivables outstanding during the year. That's what it tells us. Number 39, answer the question based on the table. So we have opening and closing debtors and net credit sales. What is the debtors turnover? So that's net credit sales divided by average debtors. To find average debtors, we add both of them together, 10 and 14, and divide by the number, which is 2, number of things we added. So 24 divided by 2 is 12, and we're going to take net credit sales and divide by that 12,000. So 240 divided by 12 will give us 20. Let's go back up and go across to number 40. If we divide 365 by the debtors turnover, what will this give us? So just like in the previous question we saw, if we took 365 and divided by the rate of stock turn, we get the number of days to sell average stock. This is what you call the debtors collection period in days. As a matter of fact, we could use any of the requisite numbers. For example, if we took 12 months in a year and divided by the debtors turnover, we'd get the debtors collection period in months. If we took 52, which is the number of weeks in a year, and divided by the debtors turnover, we'd get the debtors collection period in weeks. All right, so number 41 now. If the debtors turnover is 3 times per year, approximately how long does it take to collect receivables on average? So 3 times a year, nothing we could think of. How many months in a year? 12 months. So we collect 3 times in 12 months, assuming an even collection pattern. If you take 12 and divide by 3, you get 4. So we take 4 months. So every time 4 months has passed, we collect our receivables. And yes, 12 divided by 4 will give us back 3. Number 42. If it takes approximately 90 days to collect average receivables, what is the debtors turnover? So this is a reversal of the formula. So we could take 365 or 360 and divide it by 90, we get 4. No, yeah, 360 divided, we get 4. Oh, right, sorry, this is supposed to be 4. My bad. Okay, and another way to think about it, 90 days is about 3 months. There are 4 quarters, right, in a year, and each quarter is 3 months. So you have 4 sets of 3-month periods, or 4 sets of 90 days. So that's 4 times. Okay, so last page, finally. I think we're almost at an hour here, guys. This is a long video. Thank you for watching me this far. So what is the formula for the creditors turnover? Okay, so for the creditors turnover, that is net credit purchases divided by average payables. All right, so we have that. And what does the creditors turnover measure? Well, how many times during the year we pay off our receivables? The number of times during the year no, not that one. We pay out our standing receivables. There you go. Open and closing and net credit. So what is the turnover here? Okay, so we find average creditors. 30 and 12 is 42. 42 divided by 2 is 21. And 360 divided by 21 as 120 over 7. As 1, so 17.14 times. One would think I knew the answer by heart, but anyhow. All right. If we divide 365 by the turnover, what do we get? So this, once again, it tells the payment period in days. And if we did 12 instead of 365, we get the payment period in months. If we did 52, we get it in weeks. And if the creditor's turnover is 4 times per year, approximately how long does it take to collect receivables on average? So 4 times a year means 3 months. Because if it's 12 months in a year, 12 divided by 4 is 3. Or if it took 365 and divided by 4, you get 91 approximately. Anyhow you take it, you get 3 months or 91 days. And the last question, if it takes approximately 60 days to collect average receivables, what is the turnover? So 60 days is about 2 months. There are 6 2-month periods in a year. Right? Or if it took 360 and divided by 60, you get about 6. Okay guys, so that was a pretty long video. So I'm not going to do a long outro today. So if you do want to see the entire playlist, you're going to click that box there. If you want to view another video of mine, you can click that box there. And if you want to subscribe, please click that box there. So don't forget, like, share, and subscribe guys. I'm going to see you guys next time for one more video in this series. Bye.